Good evening, everyone. Welcome to our Mississippi State Alumni Homebuyer Workshop. My name is Jason Maida. I'm with American Pacific Mortgage. It's great to be with all of you this evening. Thank you so much for taking time out of your busy schedules on a Thursday night to join us and learn a little bit about home buying and the journey that you'll go on as you pursue homeownership. This is a class that we provide to the alumni community 4 times a year, so we do it once a quarter. I think this is our second installment of classes for 2026. And this is a very interactive class that we have. It's a runtime of about an hour, but what we'll do is we'll weave in your questions as we go through tonight's presentation, which will include just taking some of your questions on chat or on Q&A within Zoom, and then I'll kind of answer those on air. We'll also carve out some time at the end of class to kind of go through any follow-up questions that you have. And we are recording tonight's class. So if you have to step away from your computer or whatever, we'll be sharing back all of our presentation material as well as the recorded version that'll be up on our YouTube channel tomorrow. And with these classes, we hope that you'll kind of take a few things away that help you as you're deciding to make, which is probably going to be a big financial decision for yourself. Our team specifically focuses in on homebuyer education. So we provide classes to all of our communities across the country. In fact, we'll have over 10,000 people sign up for classes this year, just providing education around homeownership. So our organization, American Pacific Mortgage, is a nationwide lender. So after tonight's class, if you're thinking about purchasing in your local community or anywhere abroad in the country, we can help service you with your lending needs. So here's what our talking points look like tonight. So we're going to spend some time looking at the housing market, what's happening with interest rates. We had a lot of movement in interest rates today. I'll kind of show you kind of what we've seen with some of the changes, I guess, or hopeful changes that we have in potential peace agreements that could help move the interest rates in a positive direction. So I'll kind of give you some context around that. We're going to go through a rent versus buying calculator. Does buying make sense for me as I'm thinking about home ownership? Does looking at taking that plunge into home ownership, is that a fruitful opportunity for me? We're also going to talk a little bit about credit and some tips around credit to help really maximize your buying power, looking at different loan programs, a lot of which you've probably heard before. And then what are the challenges that we find with some of our first-time buyers is just not having enough resources to purchase their home, having enough savings. So I'm going to walk you through a savings plan for home ownership, as well as some different first-time buyer programs that are available to you, depending on what state you're looking to purchase in. And then the last topic we want to cover tonight is to look at the home buying process. So after tonight's class, hopefully you have a few takeaways that'll kind of help you decide if this is something that you want to pursue. But I want to walk you through what's the buying process look like. How do you go from classwork here to getting pre-approved, to start the home search, to finding the right house, and ultimately getting the keys to your house? All right. Well, I'm excited to join you guys for this class tonight. Hopefully you got some good takeaways. And let's kind of launch right into it. And when we think about buying, we have to really first evaluate, does it make sense for me? And this is a major purchase for us. It's going to be the biggest financial decision that we've had to make thus far. And when we think about purchasing a home, there's a lot of key benefits that go into owning a home. Things like, the affordability, right? And, when you're buying in a market like today where we are at elevated interest rates, you still have the opportunity to lock in a fixed payment. And then over time, as interest rates go lower, perhaps we can refinance our home to help lower what our monthly cost burden is. This is also an asset that should hopefully grow over time. So as our home appreciates in value, as we pay down our mortgage, the difference in those two values is home equity. And for many of us, that's our number one asset that we have. Truly, home equity has transformational opportunities for owners. It can actually create generational wealth for families and can really fund a lot of different things for them in their financial futures. There's also some tax benefits that come along with owning a home. Potential mortgage interest, tax deductibility, as well as other tax benefits that come along with owning a home. So as I get a chance to consult with our clients and really help guide them in home ownership, I encourage them to think more about those benefits, because it's truly not a fair comparison to just size up your current rent and then compare that to what your current buying power is going to be, because you have all those great benefits that go into owning a home. To illustrate that a little bit more, I thought I would share with you guys one of our calculators that's available to you. It's our rent versus buying calculator. And I always take all of our classes through this because I think it's really important to understand and compare renting versus owning a home, to which a lot of those benefits that I just shared with you. So I want to walk you through this calculator. And as I mentioned earlier, we're going to send back all this presentation material, including this calculator, which I would encourage you guys to take some time to look at yourself and maybe plug in some of your own numbers. To save us some time for tonight's class, I've already kind of plugged in some of those numbers so we can kind of walk through it. I'll just give you some context around what the calculator does. And obviously it gives you that comparison of renting versus buying. So if we made the assumption that, we're going to buy, say, a $300,000 home, we're going to put 3% down, which, by the way, that's going to be covered in our product segment of tonight's class. But on a conventional loan, the minimum down payment is 3% for a first-time buyer. That means I would finance 97% of the purchase price. And then we have an estimated interest rate, and we'll spend some time talking about interest rates tonight, as well as the term of my loan. Now, most of our first-time buyers will elect a 30-year fixed mortgage term. That means the payments are spread over a 30-year period of time. And we put an estimate of someone that's, say, buying next month, which obviously for us in tonight's class, it's going to look a little bit different, but that assumes us buying in July. We have mortgage insurance, which mortgage insurance comes into play when I'm going to put less than 20% down to buy a home. We have homeowners insurance costs that are going to vary where my property is located. So if I'm close to the coastal waters or some different perils like hurricane zones or fire zones, that insurance might look a little bit different. We have property taxes. Maybe I'm going to buy a condominium or a townhouse, then I'd probably have HOA expenses. And then we also want to calculate in the tax bracket that I'm in. So we put in here for this exercise a 24% tax bracket. We also want to assume some costs that I'm going to have as a homeowner. Eventually, I'm probably going to sell my home. So who knows, that could be 5 years, 10 years down the road. But we want to assume some selling costs as well as the appreciation. Now, homes are going to appreciate at different rates in different parts of the country. This exercise shows us appreciating about 3%. And then we look at someone that's paying in rent $1,750 per month. Now, that's going to be one of the levers that's going to change your break-even points with a calculator like this. And then we also have current today as renters, we have expenses like renter's insurance. And then we also have, the appreciation of rent. So rent could go up on an annualized basis. So what our calculator tells us, which is really, really kind of cool to see, it shows us a break-even point. So the investments I'm going to make from a buying perspective, when it comes to down payment, closing costs, as well as tax savings, appreciation, I put that in my buy column versus on my rent side, I have those expenses of my monthly rent of $1,750. Our break-even point is 2 years. That means that I'm going to be on the plus side of owning a home versus renting after 2 years. And as I counsel clients on first-time home buying, if we can get to 4 years or less, then we're in a good position. So this would be a great scenario for one of our clients to consider owning a home. Now, it starts getting a little bit more exciting as we start pushing out further on our timetables and we own that home longer, because now we potentially have more home equity appreciating. We have more tax benefits that are accruing. And you can see after 7 years, now my gain opportunity is $66,000. So not only am I ahead of, renting, I'm $66,000 on the plus side, and I've accumulated over $100,000 in home equity. So, that hopefully shares with you guys a little bit more and frames up for you a little bit more about home ownership, because truly home ownership versus rental scenarios is not a fair comparison, because there's all these great benefits that are tied to home ownership. Well, as we're considering diving into the housing market, I think the timing of that market, whether it's from an interest rate perspective or what's happening with opportunities of supply in our markets, is going to be really critical. Different markets are performing differently right now. Now, today we're in the spring buying season. So the spring and summer buying season are generally the most busiest times of the year. This chart that we're showing you on screen highlights the Mississippi housing market. You can see 48 days are the median days on market, which is probably in line with most parts of the country, unless we're in some really hyper competitive markets. And then the median sales price is at 281 with 1,800 homes sold, which is a gain year over year of 4.7%. So it's interesting when I teach classes in some of our more affordable markets like Mississippi and some other parts of the country like Kansas and whatnot, you do see a trend upwards in purchase prices, because you do see a lot of clients that are in high cost of living markets trying to take refuge in lower cost markets just to get into home ownership. So this trend, I think, will probably continue a bit in some of our more affordable markets, which is obviously great for existing homeowners in those markets. So that means we're getting a little bit of appreciation. Now, as we kind of look more closely at affordability, interest rates play a big role in what it looks like for me as a prospective homeowner. And as we look at the market right now in interest rates, it's really been all over the board. Interest rates have really been super volatile, partly because kind of what's going on globally right now with the conflict in the Middle East that has really kind of put the markets in this like up and down situation. One day we don't have a peace talk. Now, other day we do have peace talk or peace negotiations that are successful. So the market's been really on this roller coaster ride. Today, in fact, we got news that we think there's a peace agreement in place. And so if you look at, I'm going to kind of switch screens here, look at one of our dashboards that we track market conditions. This 41 means the interest rates improved probably by about 0.125 today. So rates got better by 0.125. At the same time, the stock market loved the news of a potential peace agreement, almost went over 1,000 points today. So this is unfortunately, what we've been facing over the last, 120 days in interest rates. This is kind of the market at a glance in interest rates when we look up, and this is kind of the higher these numbers go here. These are called candlesticks. The higher these go, the better interest rates are. So we got a little bit of a rally going on in the market right now. Part of it just because of what's coming out of the Middle East and potentially a peace agreement. Also, oil prices have obviously risen quite a bit, and that's one of the big energy cost items that are affecting inflation for us as Americans. And when we look at the overall cost of that we pay on a daily basis, not just at the gas pump, it could be at the grocery store, things are inflated. And so that inflation is another driver of why we're in this condition with interest rates. Now, the Federal Reserve is looking to see if inflation numbers drop to be able to get them to start cutting the interest rate, the federal funds rate. Our goal, or the Federal Reserve's goal, is to get to 2% inflation, but we're still at elevated levels, especially with energy costs being on the rise. So we'll have to see how everything plays out. There is a new federal chair. Kevin Warsh is now going to be at the helm. We'll have to see how that shifts federal monetary policy. But ultimately, interest rates are going to still kind of be in these choppy waters until we see kind of conclusion to what's going on in the conflict with the Middle East, And then, of course, as we see kind of what our economy is doing, the Federal Reserve is looking at not only just inflation, but they're also looking at what the labor markets are doing. Now, as a potential buyer, interest rates look a little bit different for different scenarios. Now, there's different characteristics that go into your selected interest rate. So even maybe your colleague has gotten this interest rate last year or bought this house and got this interest rate. It does change based upon the market. Interest rates move throughout the trading day. So when the market opens up to when the market closes, interest rates can move up and down throughout that trading period. Credit score and eligibility goes into an interest rate. The type of program that I'm going to elect can influence my interest rate. How much do I decide to finance? What my down payment looks like. And some clients will choose to buy points, which points are additional costs that you can pay out of pocket in order to bring down my interest rate. Usually 1 point is the equivalent of 1%, which will bring down my interest rate about 0.25%. And then loan term can also positively influence my interest rate. Now, traditionally, a first-time buyer is going to elect a 30-year fixed mortgage, but sometimes they'll look at 20-year loans or 15-year loans. So the shorter I can make my term, potentially the lower my interest rate will be. Now, one of the big items that obviously plays a role in interest rates and your product selection is credit. And every loan program has a minimum credit score, and we've kind of showcased those products here. We'll talk more about them in our product segment in just a few minutes, but there's a minimum credit score tied to every loan product. Now, in lending, we look at the middle credit score for all three bureaus that report out a credit score. And you guys know those credit agencies. There's Experian, TransUnion, and Equifax. So we take the middle score of all three agencies that report out. Now, you might not know this, but there's three different models to credit scoring. There's the credit card model, which will show up in a lot of your monitoring services. There's the auto financing model if you're going to run out and buy a car. And then, of course, there's the mortgage model that we're going to use in home financing. So that is the model we're going to take a look at tonight in class. But ultimately, we're going to look at the middle score of those three bureaus. So if your high score is 760, your middle score is 740, let's say your lowest score is 700, we're going to use the 740 score for qualifying purposes. If you're applying with your partner and your partner's middle score is like 680, so it's a little bit lower, we'll take the lowest middle score between both borrowers. In our review of the mortgage model for credit scoring, we're going to talk more about credit utilization and account opening, a lot of things that influence your credit score. But when you've had past challenges on your credit report, let's say a delinquent credit card or student loan, when that event happens, it's going to impact you in the most recent 12 to 24 months from the event happening. Now, will it stay on your credit report longer? Yes, it will. Late payments will stay on your credit report for 7 years, but the impact to my credit score is in the most recent 12 to 24 months. Other things like federal debt, maybe you have a federal student loan that's in collections, that'll stay on your credit report indefinitely. Bankruptcies are 10 years or less. So you can use this matrix to kind of see how long negative items will appear on your credit report. We talked a little bit about credit inquiries, which is actually under this credit model under in use and accessing new credit, but hard inquiries can impact your credit score. So you really want to avoid having new credit opened or new inquiries occurring on your credit report, especially in a 6 to 12 month period of time. Now, here's the mortgage model for credit scoring. So I'm going to kind of take you through what this score calculation looks like. My hope is that our class will find some like little areas of opportunity in your own personal credit score to see where you can maybe move the needle with improved credit score. One of our added value benefits that we provide in our consultative process with our clients that attend class is to go and do a credit coaching session as part of our free consultation. So we'll help you with this individually, but like for you guys to kind of maybe identify personally some areas of opportunity of your own. And the first section of the credit scoring is going to be how long have I had credit? So the more mature my credit file is, the better my score is going to be. So that's 15% of the weighting. Of course, I just mentioned the hard inquiries or new accounts that I'm opening up. That's 20% of the weighting. So let's really avoid opening new accounts. And the type of accounts that I open can also influence my credit score. If I get a personal loan versus a credit card, a personal loan might take away a little bit more of my credit score than opposed to maybe a credit card. With credit card debt, we look under amount owed or credit utilization. So we're looking at the outstanding credit balances versus what I have in credit limits. If I've recently charged up a little bit on my credit cards, let's say I have $8,000 in balances on a $10,000 limit, I'm now at 80% utilization. If I was to pull my credit score, it probably has pulled back quite a bit. But if I can do my best to now take those balances down to say $5,000, now I'm at 50% utilization, and now I'll probably see my score start to uptick a little bit. And then our next level of improvement would be get to 30% utilization. And then for clients that are 800 plus scores, usually they are at 10% or less of utilization of credit. One of my tips for class to help you manage down credit card debt and help to maximize your credit score is to take a look at your statement or billing cycle date for your credit cards. And what that date means, it's the date at which the credit card issuer reports out all your information for your credit card activity for the preceding 30 days. So my tip for our class is that if you can try to pay down those accounts before that cycle date ends, whether you pay off your credit card or pay it down, now you're going to get a much lower balance that reports out to the credit bureaus, which improves your credit utilization, therefore helps lift up your credit score. All right, last section is going to be payment history. That's how have we paid our bills. That's pretty self-explanatory, but if I've had late payments, they're rated as 30-day lates, 60-day lates, and then 90-plus day delinquencies. So the more severe my credit score hit is with that delinquency, probably the bigger impact I'm going to have to my credit score. Now, keeping within the theme of credit, I want to talk a little bit about student loans. Back just before tonight's session, I just got done talking with one of our clients with their own federal student loans. And, you know, a lot of our federal student debt is now going into repayment in July. I'm hearing that from a lot of our clients. If you're in forbearance or deferment, you don't actively have a payment. So you'll have some type of timetable on when you're going to start repayment. If you're looking to apply for financing today and you're not in repayment, then by default, if you had, say, $75,000 in student loan debt, we would take 0.5% as a total payment calculation for an FHA government insured loan or 1% for a conventional loan. There is sometimes we can do on a conventional Freddie Mac loan where we can take 0.5%, but ultimately that payment gets plugged in as kind of a what if to help us understand your expenses versus your income. And we'll cover that tonight. But I have a lot of conversations with clients around student loans. It's the reality of graduates now entering the home buying market. So, you know, we'll certainly have that conversation with you. If you're actively repaying your student loans, let's say you have that same $75,000 in debt and you're paying $250 per month. Well, we can use that payment right away. That's absolutely fine. I think it's where we get into some challenges if we're not in active repayment, and how does that influence what my eligibility looks like. So key takeaway here is if I'm in forbearance or deferment, let's talk through that because we're going to have to take some type of standard payment to help you qualifying for your financing. The reason why we have to do that is because every loan program that's offered through APM has some type of guidelines that help us interpret how we look at student loans. And so what I want to take you through now is just a high level look at loan programs. Some of the terminology I share back with you right now, you've probably already heard about it. So it might be some redundant information, but I want to just make sure you understand kind of what's accessible to you. So we have the conventional loan, which is a minimum down payment of 3% for a first-time buyer. That goes all the way up to this conforming loan limit, which is consistent all across the country. Some markets that are a little bit more expensive, we call them high cost of living markets. You go beyond the maximum loan amount, but the minimum down payment jumps from 3% to 5%. So that is both for a Fannie Mae and Freddie Mac conventional loan. Next product is an FHA loan that is government insured. FHA has a little more leniency around credit scores and some of the underwriting guidelines. That maximum loan amount that we're showing on screen will vary based upon where in the country we're going to buy our home. So it will change by the county. So any of my counties in Mississippi market or Texas or Arkansas, wherever, that will look a little bit different in terms of maximum loan amount. Now, both the FHA loan that you see on screen and then the loan below that is USDA. That's a United States Department of Agricultural loan. Those are both government insured loans, and they do have residency requirements. So you have to be a permanent resident to participate in those programs. If you're a non-permanent resident, you can still get access to the conventional loan, but unfortunately with those government insured products, you have to be a permanent resident. Speaking of the USDA product, it does have a zero down payment option. And then those maximum loan amounts will vary based upon where you're going to buy. And USDA is ultimately helping buyers that want to buy in more rural markets. So they're going to be more remote areas. They have to be designated as USDA rural, but they also have, as a buyer, meet income limit requirements. And then the jumbo loan here is going to be for clients that need a little bit more funding power than, say, the conventional loan. Not really typical for our first-time buyers because there's going to be higher down payment and credit score requirements. And then finally, the VA home loan. That's for our veterans that have eligibility for the VA home loan. It's a zero down payment option, a lot more flexibility from credit scores and expense ratios for the veteran just to help support and encourage that entry to home ownership. So that's kind of a look at some of the programs that you'll see in the marketplace. Now, as we look at those different programs and we decide on what down payment we want to make, there's a thing called private mortgage insurance or mortgage insurance premium for a government insured loan. I want to just walk you through and how we explain mortgage insurance. Do you have a better understanding of that? Because there's a lot of confusion in the marketplace about really what is mortgage insurance. Well, on a conventional loan, so that Fannie Mae, Freddie Mac loan, the PMI stands for private mortgage insurance. And essentially what it does is it insures lenders like us if something was to happen, there's a default by the buyer, they couldn't make their payments. A mortgage insurance company will protect us against that default. Now, mortgage insurance is paid for by the buyer, and there's characteristics that go into the premium of the PMI, things like down payment, credit score, and how much I finance. And there's a cancellation option on PMI. So once I reach 2 years in that original loan and 20 to 22% equity, I can apply to have the mortgage insurance canceled. So that's one of the big benefits of conventional mortgage insurance. And we provided the calculation of what the premium looks like just below in the slide, which is if you're financing $300,000 and you have a 740 credit score with a 3% down payment, your PMI is probably about $92 a month. Okay. So if you've already started your search on Zillow or Redfin or any of the platforms, those calculations might look a little bit different just because they're not calibrated to some of those characteristics I just presented to you. On the other side of our slide is a government insured FHA loan. Now there's two forms of mortgage insurance for FHA. There's monthly mortgage insurance and upfront mortgage insurance. The difference with the conventional loan is that it's going to be a little bit more expensive on an FHA loan than conventional, and there's no cancellation option for FHA. You basically would have to use FHA as a refinance opportunity down the road. I look at FHA as the ability to help provide a little bit more flexibility to our clients that need it for qualifying. But as they improve their financial situation, we're trying to refinance into more of a conventional loan to help limit the amount of expenses. You may see in your online searches FHA rates looking almost like 0.5% lower than conventional, and they might be in most cases, but what you don't see behind the scenes is really the cost of mortgage insurance. So mortgage insurance is going to be much heavier when we look at the FHA product. But again, a little bit more flexibility in qualifying. Here's what those costs look like in mortgage insurance. You can see there's upfront mortgage insurance and then monthly mortgage insurance. All right, we're going to now kind of just transition into employment for homeownership, and we're going to go through some different scenarios for you. I also wanted to share back with you some of the different documentation needs that we'll have. So as you think about kind of taking those next steps in homeownership and going through the consultative process with us, I wanted to kind of give you some of the documentation that we generally will ask for, and which you can upload right to your application profile. And then as we think about different employment scenarios for home buying, I want to kind of walk you through a few different ideas around that. Because as we look at qualifying clients for homeownership, we do have to verify a 2-year work history. That includes their current job, but it can also include educational background. So if I just graduated from Mississippi State, let's say at the end of 2025, I just finished up in the fall, and now I just started my job this year in 26, I could still be potentially eligible for financing because I can piece together my education plus my new work history in order to establish my employment. So I really only need to identify a 2-year work and or educational history. So a lot of clients in marketplace think they have to at least be on the job for 2 years, which is just really not the case. You know, we've had some examples, even as of late. One of our clients purchased in Texas. They're just going to start their job next month, but they just got the keys to their house on Monday, because we can actually qualify clients with as little as an offer letter. As long as it's an unconditional offer letter and we have a start date for them, they can still purchase a home with that offer letter and close escrow. So there is options for you to get access to homeownership, maybe quicker than what you thought of. Now, if you're in a position that has like variable compensation, whether that's bonuses or commissions or whatnot, now in that case, I do have to show that you've been on the job 2 years, because we're going to average the historical earnings in that position. So we'll look at, you know, what you made in the last couple of years to identify how much of that income we can use for qualifying. If you're in an hourly position and you get overtime, that would be another scenario where I have to show that you've been on the job 2 years. And if you want to count that overtime, we have to look at how you've kind of trended in the overtime over the last couple of years. If you're self-employed, we want to verify the last 2 years of tax filings. We'll also do an analysis to average out those last 2 years of tax filings to see what that looks like for you. And then the last thing I would just want to share back with you is that if you're in a full-time position, but then say you're also driving for Uber or Lyft on the weekends, that Uber or Lyft income, that is 1099 income, which shows up on your Schedule C for your personal 1040 tax filings. If I want to include that income, then I have to show that I've been doing both jobs simultaneously for the last 2 years. All right. Any questions on some of that content so far? We're going to go kind of talk a little bit about expenses versus income, but I want to make sure I take a quick pause for our class and open it up to any questions that you might have so far. All right. And I know I'm right in front of your dinner plan, so I appreciate you guys hanging in there. Hopefully you're getting some good takeaways from our discussion tonight. I want to just quickly talk about expenses versus income. So in our analysis of qualifying for clients, we take a look at what your projected housing payment is going to be, which would include the principal and interest of my new mortgage, what my property taxes look like, homeowners insurance, mortgage insurance. And then we include what your existing expenses look like, whether that's student loans, car loans, credit cards, any of that stuff. And then we take those expenses and we can compare them versus your gross monthly income. We call this calculation debt to income ratio. And we've kind of highlighted the example of the calculation up on screen with kind of a real-time example, which shows someone that has $3,000 in expenses and then they make $8,500 a month. So essentially the debt to income ratio tells us that 35.3% of their pre-tax income is consumed by those expenses. Now, in underwriting guidelines, as we're helping clients, we can't go any higher than 45 to 50% in some cases. And that's obviously on the high end. I get asked the question often is, Jason, you know, hey, what should my expenses be in relation to my income? My comfort zone that I see for most clients is around that 33 to 36% debt to income ratio level. It works in some markets and it may not work in all markets, but I think that's a good indicator of pretty good affordability levels. Let's face it, it's challenging in most parts of the country just from a cost of living perspective. So we understand that. And as we meet with you for a consultation, we're going to figure out like what does an affordable level of monthly payment look like for you for housing for you. Because even though the debt to income ratio says I qualify for this, doesn't mean that's where I should buy. And so we'll help give you some counsel around that. Well, let's talk a little bit about savings for homeownership. And I want to walk you through kind of some of the acceptable documents that we can verify, like how much I've already saved. And so on screen, you can see some of those sources that we are allowed to look at in lending. Of course, checking and savings accounts can be used. I put a note here if cash is not acceptable. What that means is that we can't use cash, tangible cash, and any assets that essentially are in those accounts have to be seasoned for at least 60 days. So we have to check any type of large deposits. Now, 401ks can be used where you take loans against your 401k or withdraw. Even investment accounts, I would just encourage you to talk to your tax or investment advisor just to make sure that's the right move for you financially. And then gift funds can also be used in a home purchase. And that's where a family member is essentially gifted a contribution to help lessen your out-of-pocket burden. And there's no seasoning requirements for gift funds. We just have to go through like a documentation process. Well, as I think about all the clients that we help across the country, it usually comes as the forefront that savings is a challenge for them. And so we kind of just started thinking through like more of a savings plans for clients. And it's a very simple approach to saving for homeownership. And I was working with some clients yesterday and kind of figuring out like what's their target need to be able to get access to homeownership. And so if you're in a situation today, let's say you're paying $1,500 a month in rent, but after you go through the consultation with us, we believe that your target payment probably is going to be around $3,000 a month. Our savings plan would say, let's start saving today, like we're actually making that $3,000 mortgage payment. So on the first of the month, we continue to pay our $1,500 to our landlord, but we get that habit or behavior of taking an additional $1,500 and we move it right to our savings account without questioning it, right? We don't put it towards anything else. We continue to do that meticulously as a discipline every month for 6 to 12 months. At the end of 6 months, I have $9,000 accrued. At the end of 12 months is $18,000, not including if I decide to park that money into a high yield account. So I know that's probably easier said than done, but that's a great way to get on that path towards home ownership, maybe a little bit quicker, especially if savings is truly the area of opportunity for you in your financial profile. Now, assistance programs can also help you get to your goals a little bit quicker. In the state of Mississippi, there's programs like the MHC loan program, which provides anywhere between $6,000 to $10,000 in assistance. It is essentially a low or zero interest rate loan. And there's also special incentives for teachers. And you may have heard about a mortgage credit certificate. What it does, it provides a tax credit that helps lessen your tax burden by being a homeowner. So in some MCC programs, you can get anywhere between a 10 to 15% tax credit on your home mortgage. So those are certain things we can talk through as part of a consultation if you are eligible for those options. There are various assistance programs all across the country. So I know we're talking about Mississippi, but there's agencies called HFAs in almost every state across the country. They're designed to support affordable home ownership for low to moderate income households. So depending on what state you're looking at, just connect with us and we'll get you aligned with the right resource that can make sense for you in your home buying journey. Internally within APM, we have our 1% down program, which essentially if a buyer puts 1% in on their down payment, we'll grant you another 2%. There are some limitations in terms of sales price, and you have to be below 80% median income. We also have our Pathway DPA program that's good on an FHA insured loan, where you can get up to 3.5% to 5% of your sales price in assistance. So a lot of great resources that are available to you as prospective buyers. I think the myth in a lot of the markets that I teach in is that I have to hit that savings goal of 20% to get home ownership. And hopefully after tonight's class, you're saying, hey, you know what? I just got to get to 3%. Or maybe I can tap into some first-time buyer resources that I otherwise didn't know existed. Last talking point for tonight, I really think that's probably one of the most important ones, is just the buying process. After tonight's class, where do we go from here? What resources can we pull from to be able to start my journey towards homeownership? Well, the first thing I would recommend doing is to get connected with us for your free consultation that we provide to our local community. It's a virtual 30-minute session we do with you to analyze your finances, talk through credit, see what programs make the most sense for you, and then kind of really have some design work done for you in home financing. And then if you're ready, we're going to issue a pre-approval for you that can help kind of launch you into home ownership. It's not something where you have to go out and run out and buy a house this weekend. It might be a goal for next year, but we're going to just provide a baseline setup for you with your financing so you're ready to go when the time does come. Now, that time might be soon, but whenever it is, the next step in the process is to start the house hunting phase. And that's a home search that generally starts online. and then probably eventually kind of morphs into going out in person, maybe visiting some open houses. I would encourage you to connect with a local realtor that will help kind of be really your eyes and ears as to what's available in the community that you're seeking. And they should be experts in their market and be really connected with what's happening and what's really most important for you on the community that you're selecting. Well, the longest phase in the buying process is probably this one, probably step 2. It could be 2 or 3 days, it could be 2 or 3 weeks, it could be 2 or 3 years. So it really just depends. Now, eventually, you're going to find that home that you love, and you're going to make an offer through your realtor to that seller. The seller might accept it on the first time. It may take quite a few different passes at the right home before you get an accepted offer. But let's say you get that offer accepted, then you're going to move to step 3, and that's called entering escrow. So that means a seller has accepted your offer, and now you have now started the buying process. And usually to go from accepted offer to getting the keys to your house is going to take about 30 to 45 days in most markets across the country. Now, when that occurs and you have that accepted offer, it's going to start kind of putting in motion more of your financing. And that day we get word of the accepted offer, you're going to get a call from me saying, hey, congratulations, you did it. Your offer is accepted. Let's talk a little bit about next steps. And then I want to schedule you for your follow-up video session. So we can spend about 45 minutes virtually to kind of go through all the fine-tuning design work of your financing, talk about the timeline of events, and just set some milestones for you in this journey to go from accepted offer to getting the keys to your house. You'll also have other action items as a buyer, things like making a deposit for your house that shows the seller that you have a financial interest in the success of the transaction. The deposit is usually 1 to 2% of your sales price and gets put into a title office holding account, like escrow, or an attorney office holding account. But ultimately, what it does is it's going to be funds that are put into the transaction, but they will count towards your total out-of-pocket expense. And in most parts of the country, there are contingencies as part of the real estate contract. The contingencies allow you to do a little bit more kind of research on the property once you're under contract with the seller. Things like getting your house appraised to make sure it's worth what you're buying it for, getting your inspections done on your house to make sure the house is truly in good condition and you're happy with what you've found. Make sure there's no dry rot or roof issues or plumbing or electricity, whatever the case may be. And then finally, of course, getting your loan approved, which our APM team will be a part of. That is part of our internal process, and we prepare for underwriting in step 4, which is a lot of the administrative work we do. We're verifying employment, assets, making sure your product is all structured properly. And then, as we talked a little bit about interest rates, they do change by the minute during the trading day. Once you're under contract with a seller at step 3, we're going to start having strategic conversations about how do we time this kind of volatile market and try to time the lowest interest rate opportunity. And as you move through these milestones, you'll get electronic disclosures that deliver out to you that highlight everything that we've reviewed during that follow-up session. And once we get to the kind of the latter stages of the process, at step 5, we're going to be issuing to you a final disclosure. It's called the closing disclosure that gives you a 3-day cooling off period before we get to the final closing stage of the process. And as we roll into that milestone, that's the really one time that we need you in person, where you'll be signing final loan documents with an attorney, a title officer, a public notary, depending on what state you're in. Most parts of the country, it's what we call a table funding state. So the date you sign those final loan documents is the same day that you're going to wire in your final funds, as well as our APM lending funds. So that'll all come in that day. And then documents will get recorded with the local county recorder's office to transfer ownership and secure your home purchase. And then once we get word of that, you've become the official homeowner. And that's a huge, huge day of celebration. It's a massive accomplishment. And we want to be there, obviously, right there, right along with you to celebrate the huge accomplishment. Now, our relationship doesn't end there with you. Part of our home loan aftercare program is to always watch what the market's doing. So if interest rates are improving after you bought your house, keeping you top of mind. So if we see a 1% reduction in interest rate, we want to get connected and see what we can do to try to capitalize on refinance opportunities, as well as giving you our HomeBot system to track your home equity. And of course, checking in with you annually just to see how you're doing financially and if there's anything that we can help to continue to serve you. Well, as we kind of conclude tonight's class, I wanted to kind of give you those steps to get started in the consultative process if you so choose to. It really starts with these really simple get started items like doing your online application, which just takes 4 or 5 minutes to complete. You'll upload some documents, and then you use our scheduling system to schedule your virtual or on the phone session. We always encourage you to do the virtual session. just because it's a very interactive session where we can do some screen sharing and go through different budget calculations and credit counseling and all the important things that are going to help kind of shape what your home buying scenario looks like. This is kind of what that consultation looks like. So those are some of the talking points that we go through, including budget, location, assistance programs, maybe some areas of opportunity with credit, and just kind of really having a great outline of what homeownership can look like for you. I did want to point out that we really try to embrace technology in our process, whether that's using mobile tools, AI, to make sure that we're giving you all responsive information, but correct information. But it doesn't replace what's really important is the human touch in the home buying process. So you can't replace technology. You can't replace human touch with technology. And so that's why we're always connected with our clients, whether that's on phone, calls, emails, because we understand this is a massive financial decision. We want to make sure that we're connected with you throughout that process. Well, as you consider joining us with your path towards homeownership, I just wanted to spotlight, we do provide a discount in our services through Mississippi State Alumni, where we discount our closing costs. Of course, you always have access to our first-time homebuyer classes. They're a free service we provide in our community, but we just want to make sure that you have an affordable housing option for you. If you've enjoyed tonight's content, love to be able to share that back with your friends, family, or coworkers. But we also have other alumni partnerships in different parts of the country where we teach very similar classes and just try to really impart some great value on what homeownership could look like. Here is all my contact information. So if you'd like to get connected with me after class, love to be able to meet with you and just understand how I can help support you in this journey. That's all my information there. We encourage you to kind of check out what people are saying about us online, whether that's, what we see in some of our reviews on Google or Yelp or just Reddit communities that are talking about how we're serving them in homeownership. And of course, we always want to share back really great tools and resources on our socials like Instagram. So try to really have a lot of good stuff there. So feel free to follow us there if you want to kind of see what's happening in the community. With that said, I'm at the end of tonight's class and I want to open it up for questions. So if you do have any questions, just drop those in the chat or Q&A and we'll answer those on air before we wrap up tonight. And I appreciate everyone sticking with us. We made it all the way through. And I know, like I said earlier, we're just before dinner time in most time zones that we're broadcasting in. So thank you so much for being a part of this class. Any questions that come to mind for you guys? Okay. All right. Well, I'm going to take that as we had very thorough content and you guys hopefully enjoyed what we presented to you. As a reminder, we're going to share back all these presentation materials tomorrow to you. And then we've recorded tonight's class, so that'll be up on our YouTube channel. So feel free to look back at some of your notes. And if there's some things that you want to kind of cover again, take a look at the recorded version, but also certainly reach out to me if there's anything I can help with. Have a wonderful evening. I look forward to seeing you all soon. Good night.